A lot to get through and lots for investors to chew on, Michael. Give us a sense of what you're looking for in particular.
Well, I think the message from the data this week is going to reinforce the idea that we're seeing an extremely strong recovery in the US and European economies, while China and Korea, Taiwan are beginning to, well, have been moderating. The virus hit this part of the world first, so that's partly just the dynamics of the disease. But obviously, we're expecting this extremely strong fiscal stimulus in the U.S., and that's really going to power growth in the U.S. and Europe as Europe comes out of lockdown. Middle of this year, we're going to see annualized GDP growth in the U.S. and European economies north of 10%. I don't think we've ever seen growth that strong in these countries. And remember, this isn't just coming out of lockdowns. This is fiscal stimulus, very easy monetary conditions. So we're going to see extraordinary strong growth in the US and Europe. That will benefit exporters in Asia. But the broader story in this part of the world is in many economies, domestic demand is really struggling to get going after the COVID shock. The inability to vaccinate large numbers of the population is really holding back the domestic recovery in Asia.
Yeah, and also in Europe, where we're getting a third wave, Michael. The thing is, we've got possibly a $3 trillion infrastructure package coming out of the Biden administration. Are we ultimately also borrowing growth from the future?
Well, to some extent, of course. You're running large fiscal deficits, debt's going to go up. I think what has changed in policymakers' thinking this time around, though, is, after the global financial crisis a decade ago, they quickly went into an austerity mode, and that really short-circuited the recovery. This time around, I think what you're seeing, particularly from the U.S., as you said, $1.9 trillion fiscal stimulus package this year. They're already talking about a multi-trillion-dollar infrastructure investment program over the next 5 to 10 years. That's going to support growth, say, in 2023, as the economy will be slowing back down to trend. So the thinking this time around is, with interest rates extremely low, if not negative, there really isn't the need to tighten the fiscal belt the way it was perceived to be a decade ago. So this is going to allow these economies to continue to grow quickly. We're going to have to get used to just much higher debt levels. And as you alluded to, the risk is that inflation beats to the upside over the next few years and drives interest rates higher. And that short circuits the plan currently to have this very easy fiscal policy continue through 2023.
Michael, very easy fiscal policy, certainly, but we are looking at tightening too, and I assume PBOC probably one of the first in your foresights, particularly as we look at signals here from what we've been seeing in the recent yuan movements as well. What are you expecting from Asian central banks heading into the latter part of this year and I guess into 2022 as well?
Well, it's really into 2022. So PBOC, I would argue, has already started easing off on the stimulus middle of last year. Certainly by Q3, interest rates had bounced back up to pre-COVID levels. Credit growth was slowing down. And the message really for 2021 is moderation, gradually withdrawing this fiscal and monetary stimulus. We think that could translate into 20 basis points of MLF rate hikes in the second half of this year. For the other central banks in Asia, for the most part, you're looking at central banks that aren't going to be in a hurry to tighten monetary policy. The Fed has signaled they're not going to raise rates till 2024, the ECB probably long after that. So we do think by the middle of next year, most other Asian central banks will have started raising rates. But to be honest, it's not a tremendously high conviction view. The view is they want to be pretty much done with normalizing policy before the Fed starts. So that leaves them 2 years, 3 years from this point to get that done. So our view is by the middle of next year, most of them will have raised rates once, maybe 2, 3 at the most rate hikes in 2021, and a similar very gradual pace in 2022.
And which of the economies are you most concerned about here in Asia, given we continue to see the likes of lockdowns in the Philippines and, as you mentioned earlier, perhaps a bit of a slower vaccine rollout than perhaps was expected or anticipated?
Well, it is Philippines, Indonesia, Malaysia, and I have to still worry about India, although they've done remarkably well over the last year, I think. But for those Philippines, Indonesia, Malaysia, the vaccine rollout we anticipated was going to be very slow. It has been extremely slow. They're really struggling to contain the virus, as you say, new lockdowns. So it's really these economies, if you will, ASEAN ex Singapore and maybe Vietnam, where domestic demand is going to remain extremely weak because people are simply unable to or afraid to go back to a more normal economic existence. Exports are doing extremely well, but domestic consumption and, of course, investment, I think, are going to remain weak for another year at least.